Hello everyone, it's Saturday, January 6th, here with the weekend market review. We saw another choppy session on Friday to end the tumultuous week, but the Friday session was, a little bit of an unexpected one because you weren't really expecting to get the bounce that we did in the morning. And the reason I say unexpected bounce is because the job numbers came in hot, materially hot. So there were more jobs added than expected by a material amount. And what we've been expecting for the past couple of months, quarters really, is that good news economically is bad news for the market, meaning that it's going to force Jay Powell's hand to keep raising rates. And we did not necessarily see that reaction today. In fact, during pre-market trading, the initial reaction was a move lower in the equities, but as the morning wore on, there was actually a significant move higher that was eventually met with selling before kind of just chopping around for the remainder of the day. So a largely indecisive market is what we can pull out of that. It's very difficult to say what frame of mind the market really stands in as of right now. Is it in the frame of mind now that good news is actually good news? Or are we still in the good news is bad news camp? And I think today really proved that the market is a bit undecided with regards to that. And it's always a difficult endeavor to try to read the tea leaves, which is why I always advocate for just following price action. Because in the end, price action is how market participants express their belief in the market. And at the end of the day, price is the only thing that really matters, and you're going to lose every single argument that you have with price. So you just got to cut out all of the mind reading and just follow the price action. So obviously a tumultuous week, tumultuous start of the year really. And I'm going to go through the charts, but let's start with the intermarket comparison chart, as I will do going forward every weekend now. This is the trailing 12 months. Bitcoin still by far and away your leading asset class. Has been very, very choppy recently. The Q's in second place here. You can see it's pulling back a bit over the past week, as well as the SPY and small caps. What was on the move? Well, you had your 10-year yield and crude moving higher, and that will be more notable here as we get into the year to date, which at this point is simply 1 week of price action, right? So the chart will start to fill out with time, obviously, but for now, year to date, you can see it's been quite the week here, and I think it's worthwhile taking a look at, even though it's literally 4 days of data here, but it does show kind of a stark change from what I just showed you in terms of the last 12 months, where Bitcoin was your leading asset by far and away, with the Qs being your second leading asset class. But to start the year, kind of the opposite, right? We got crude moving higher, some defensive assets moving higher, the 10-year yield, the dollar index, whereas the Qs, SPY, and IWM, along with Bitcoin, all kind of pulling in, right? So we have our risk assets pulling back as risk-off yields, dollar, and oil move higher to start the year. And that's a dynamic shift, right? How long does that last? Does it last? That's the open question here. And this is why we take on this endeavor of trying to analyze the market and attempt to make sense of trends. I love following trends because trends are, they're your friend, as the old cliche goes, because they tend to keep moving in the direction of the trend, and you can take advantage of that. You can exploit that trend. So does this become a new trend where crude starts moving higher, 10-year yields move higher again, the dollar index moves higher again? And if that's the case, it would be a major negative for equities because, as you know, yields and the dollar generally move inverse the equity markets, so it would likely lead to equities trending lower. Jury is very, very much out. We only have 4 days of data to work with, but starkly different contrast to start the year. Let's move to the 11 sector spiders, so each of the sectors that make up the S&P 500, to see how each is acting. And once again, we will use the trailing 12-year chart here, so the past 12 months. 3 leading sector ETFs here: technology, communications, and consumer discretion. Once again, the big weighted names in these sectors are as follows: technology of Microsoft and Apple, communications, you have Alphabet and Meta, and then consumer discretionary, you have Tesla and Amazon. Those are your big 6 main names that comprise the meat of these 3 sectors. Obviously, there's plenty more names in there, but those are the big names that carry almost 50% weight in each of those sectors. So when they have a big year, so do these 3 sectors, right? All the others are lagging behind. But industrials made a decent run, financials making a decent run, and that's where we're at in terms of the trailing 12 months. if you look year to date on this, it's going to be a big jumble, right? So again, difficult to analyze 4 days of data here, but in the new year, based off the small data set we have utilities, healthcare, financials, and energy as your leaders so far. 3 of those 4 sectors being defensive sectors. So those are your leaders that are holding up better as of right now, whereas your laggards are surprisingly technology, consumer discretionary, 2 of your previous year leaders. But to be fair, they are just coming off of massive moves to the upside, and a pullback was to be expected, but still technically lagging on the year. Just looking at the 1 month time frame, which gives you obviously a little bit better of a picture because it's got more data to it. There was a big push in healthcare, right? With just alongside financials, big push in healthcare, financials. This is where your relative strength has been. So when I look at the past 1 month performance, like I do in my technical scan, this is where the majority of your names were coming from. And I'm going to start to share that relative strength scan each weekend with you guys, so you could help you guys track stocks that have been outperforming the S&P 500 on a 1 month basis, which is going to help you also see current themes that are emerging in the markets, so you can get involved with stocks that are potentially just beginning their moves. And here's that scan this week. You got finance and healthcare. That's 50% of the names in the scan, right? Banks, pharmaceuticals, biotech. That's where the money's really been flowing. So it's been a drastic change from the software and semis that were getting all the love just a month ago. I mean, software and semi names are holding up, but they're not dominating the relative strength list over the past month. Now, pharmaceuticals, biotech, healthcare, and financials have really taken that baton. That's simply where the action has been and where we want to focus our attention in terms of stock selection. One of the major benefits of trying to show this process is that hopefully it's giving you an education about the dynamics at play in the market and the way that the market can be read in terms of analyzing, through various illustrations like this, various different ways of slicing the market and presenting data to give you a better feel for the market. It's not just about getting a simple formula like if A happens, then do this. You want to try to understand how the market's moving, what's moving, what areas are showing strength, where is money rotating? And these are the ways you could simply look at the market to try and get an understanding of it. Does it mean we could read the tea leaves? No, but you're essentially flying blind if you're not doing any kind of analysis like this kind of top-down analysis, at least in my book, right? So there's the relative strength list. I'll leave it with you. A lot of names on there you may never have heard of. That's definitely the case for me. There's a lot of names on there showing relative strength that are just not the usual names I would be trading. Now, before I get into the charts, let's look at the breadth on the day for Friday. We can see the intraday charts showing that initial thrust higher in the early morning hours, which was eventually sold into. That ended up being the high of the day, right around the 10 a.m. area. You could see each of these indexes essentially flat on the day after a lot of sound and fury, right? So sell-off, bounce back, sell-off, bounce back, choppy day. Really the definition of chop. In terms of breadth, advancers and decliners, arm wrestling match, advancers outpacing decliners by just a smudge, new highs outpacing new lows by a smidge. Not much going on there, right? If you look at the capitalization hierarchy, large caps, mid caps holding up pretty well, mega caps mostly flat, small caps floundering a bit more on the day, largely choppy action though. I would argue that the fact that the market did not materially sell off on the hot jobs number is relatively positive news, because you would have expected the knee-jerk reaction to have absolutely been hot numbers, meaning good news for the economy, means bad news for the market. That's how it's been for the last 6 to 8 months, right? And that's not what played out. At least it was not loud and clear that that's what played out. So I maintain that as being relatively positive, and I think that it was constructive. Now let's talk about the economic calendar coming up. We've got not much Monday, Tuesday, or Wednesday, so nothing there to really act as a catalyst. But the big news is definitely going to be CPI and PPI. And I would argue that if we have these positive economic numbers and inflation still remains in check or even cooling off, it's basically the ultimate Goldilocks scenario, as the saying goes, right? Where you thread the needle, not too hot, not too cold. You've got an economy that's humming along, but not so much that it's keeping inflation roaring. So I think that the market would really like to see inline or lower CPI and PPI. I think those reports are going to be the big deal breakers once again. Unfortunately, that's just the way it goes. Looking a little bit further out, Monday of next week, the markets will be closed for Martin Luther King Day, so keep that in the back of your mind. Let's now go to the price and volume charts. I'm going to start off on the weekly time frame because it's just the perfect time to do it. Here we have SPY pulling back lower. It was a choppy week overall, down about 1.5% for the first week of the year. And if you are a believer in seasonality, it's a bad omen to have this Santa Claus rally not occur. And that absolutely did not happen, right? We did not move higher the last 5 trading days of the year and the first 2 trading days of the new year, which are the 7 trading days of the year that compose the Santa Claus rally, right? On average, it's up 1.3%, whereas this year, markets were actually red. So, no Santa Claus rally. Santa did not show up for the rally this year, so presumably that's a bad omen. I don't really care about that all too much. What's interesting to me is the tone change to start the year. I think that if the tone change continues or even strengthens to the downside next week, we have a very different market on our hand. For now, it's really just a reasonable pullback, albeit quick, but a reasonable pullback, and it's something we obviously want to keep a close eye on. Now, take a look at SPY here, coming back down towards the 2022 high. We'll see if it can hold that level. This was a 9-week run. Is this enough of a pullback? Maybe, maybe not. Perhaps it needs some more time. It needs to come in further. We don't know. We'll just have to wait and see. RSP, your equal weighted S&P 500, coming back in as well. But you saw the nature and the velocity of this move higher towards the end of the year, November, December. Frequently, when you have those high velocity moves, they require more substantial pullback. And that's one of the reasons, again, why I always favor having pullbacks along the way. More moderated pullbacks along the way versus these massive rocket ship kind of thrust. But you don't always get what you want in the market, so you got to adapt. But in any case, RSP negative on the week as well, down 1.3%. And then we got our Qs, showing a little bit more weakness, down 3% to start the year. So the Qs off to a lagging start, coming out of the gate slowly, showing some serious selling on what was your leading index in 2023. So this has come back down below the 2022 high, and the same question goes here. Is this enough of a pullback to get going again, or will we need to pull back further? We'll have to see. IWM coming back deeper into the range again. So we had that brief moment where there was this 2-week pop outside of that range. It was a breakout attempt, and we've since fell right back into it. So we've closed this gap, which you'll see more clearly on the daily chart. Definitely would want this to turn around and start moving higher relatively soon if we're really going to get that next leg up. How far back does this need to pull in? That's something we simply don't know, but we will walk through some potential scenarios that we could expect on the daily charts for the indexes shortly here. But again, I believe this is all a factor of how quickly, how ferociously this move in November and December was, and obviously it requires some sort of pullback to digest that move. Mid caps back down to that pivot line, so a little bit more constructive technically than the small caps chart. And then we have the Dow Jones Industrial Average kind of just hanging out here. Have a doji, overall very strong index, but the steepness of this ascent, the level of this trend line's angle of ascent simply cannot last, way too steep. So it's time for a new trend line to develop here. If one is going to do so, it's got to be at a different rate of ascent. Now, I want to go into sectors on the weekly time frame because it's always good to do on the weekend, and it just so happens to be part of my top-down process. So financials here have been rip-roaring higher. Talk about a rocket ship kind of move, right? We start earnings season on Friday of this week, so the market really doesn't have much of a catalyst until the end of the week. Because of that, we could potentially just see some chop, maybe even some more selling play out. We'll have to see what happens, but I would argue that CPI, PPI, and earnings season starting up are going to provide more than enough catalyst for the market to start to make its mind up, with Thursday and Friday being that CPI, PPI. So having a look here, communications coming back in slightly, having a pretty decent week here. Overall, though, down less than 1%. And again, 45% of this ETF is Alphabet and Meta. Consumer discretionary coming in a little bit steeper here, down almost 3.5% on the week, still above this downtrend line, still above a rising 30-week moving average. And about 45% of this ETF is Tesla and Amazon. Tesla not having the best week in the world, honestly no surprise there. One doesn't have a good week. Amazon coming back down fairly dramatically as well, so not too surprising there. It really shows up in this ETF. You could see how both of these have been fairly weak over the course of the last week. Industrial is pulling back a bit as well, but is coming off of this big move up to all-time highs, coming back down a little bit. You would expect a little pullback, and so far, just your standard pullback. Everything looks healthy there. Exactly what you would expect after 9 weeks straight to the upside. Utilities, not very concerned with it, but it is above the 30-week moving average. Materials came back up to test the top of this range, pulling back just a little bit, so overall strong move in materials as well. And then here's healthcare, the sector du jour, there's no doubt about it. Big move here to test new highs, coming back in a little bit to end the week, but maybe this keeps going and stages a real breakout to new highs here. We'll have to see. A lot of the names under the hood, though, for this sector are extended, so I'm not really seeing anything I would really want to take necessarily in the healthcare sector at this time, but should it pull back in the coming weeks, we may see some interesting setups in that sector. Energy kind of going sideways. Extreme volatility right now around this 30-week moving average. Technology coming back in relatively hard to start the year, down about 4.3%. So your leading sector on 2023 selling off during the first year of 2024. Really, once again, not too surprising there considering how powerful of a move it's coming off of. Pullback here would be perfectly normal, especially when you factor in that, potentially the sell-off that we're seeing right now in tech is just due to some tax selling where people held off on selling their big winners until the new year. So then they don't have to pay taxes on it until 2025. So there's really no way to know if that's the case or not, but it is something that professionals do on a regular basis, so it wouldn't be surprising. There really is no way for us to know that. However, if next week and the week after that we do continue to move lower, then we know that it was not actually tax selling, right? It's a legitimate technical weakness that is turning into something more potentially. So it's possible that at least part of this was some tax selling to start the year. Some of the big winners that were up, mid double digits, people sold off after the year end so that they could delay that tax hit. Real estate, REITs, this is a yield play, and when I say yield play, all I mean is that this sector specifically moves very closely to the 10-year yields, specifically inverse of the yields. So they obviously like falling yields. You could see they're pulling back here a little bit in response to the recent strength in yields. And then staples, defensive sector here, moving sideways for a better part of 2 years, but above its 30-week moving average. So you could see very constructive charts on the sector levels, right? Financials pushing relentlessly higher, healthcare pushing new highs, industrials into new highs, and even your leading sectors from 2023, although there is some selling that's obviously taking place there, they are holding up overall, and it's been constructive price action. So communications holding up relatively well, consumer discretionary still holding up well. Just really looks like what's occurring right now is a pullback within an uptrend, and same goes for technology. So big picture perspective, everything does look fine. There's no critical damage that's been done. Obviously some stark selling to start off the first week of the year. There's no doubt about that. Let's keep it all in perspective. But overall, really nothing to be too concerned with at this point in time. I'm going to start going through here chart by chart in the daily because I think it's worthwhile at this moment to just take a view of what's going on. So first, I'll take a look at my open positions. I'm in 2 names currently. Spotify, it's the second day that we're holding it. We bought it out of this wedge range. Held up pretty well. I like the price action. Fairly constructive. We have an inside day. In fact, if you're not in this, you could really buy this over Friday's high using the low of that candlestick as your stop loss because it could potentially push off this 20 EMA. Here we have Shopify. I took this Friday with you guys. Started strong, but faded a good portion of its gains along with the broader market. So now the question is here, are we bear flagging into the underside of this 20-day moving average? It's something that we don't know yet, right? There's not enough information. We've had a few days of selling, and then we have a bit of a bounce. It's definitely a stock that's showing strength versus the broader market, but does this bounce turn out to be one that sticks, or is it going to fail, right? Time will tell. I tend to give the current trend the benefit of the doubt, and that's what I'm going to do for now. However, if I start to see a bunch of bounce attempts fail, we're going to have our answer here. These are more, in that case, these would more than likely be bear flags. One more thing about this chart, Shop, it's a volatile name, and it's a good example of why knowing your dance partner is so important. Obviously, the volatile nature of Shopify is a very different dance partner than, let's say, Microsoft. And because of that, your expectations as to how that stock is going to move, how it's going to act while you're involved, is going to be different. If you guys don't know things like that by now about the stocks that you're following, that is education that you must learn the hard way, right? By watching price action in certain names. You got to start to understand the difference in personality. Something that can make this easier on you is simply by looking at the ADR, the average daily range of a stock. If it exceeds that of 3%, it tends to be one that's going to be more volatile. And because of that, you're going to expect to be kind of thrown around a little more while actively in that stock. So you don't want to enter a stock not really taking any note of how its personality is. So with that said, still holding on to Shopify with Friday's low as our stop loss. Let's just see how it plays out. Let's have a look at the index daily charts quickly, get an idea of where we stand short term, and then we'll review names that I'm watching but not really seeing tons of setups that I'm particularly enthralled with at this point in time. So this is going to be much more of an observing price action kind of week. SPY closing just above the 20 EMA after rejecting off the 10 EMA 2 days in a row. So sellers clearly defending that level. It's clearly an area of significance and could act as a pivot point where, if captured, buyers step up and try to push the index higher. Also note this minor downtrend line that formed last week gives us a level of confluence with a 10 EMA. So confluence level, you have two different resistance levels overlapping one another, makes that area more significant. Definitely want to keep an eye on that 471 area because of that. A break above it could lead to a retracement of the top of this range at the very least. The odds of that move extending to the range high increases if we break above this 472 level. And you may ask, why 472.5? What is so significant about that level? Well, if we fail to break above that level, this is more than likely just a bear flag in development. If we do break above that level, then the bear flag is no longer valid, because technically price should not retrace more than 50% of the prior move, in this case the prior move down, and if it does, then it invalidates the bear flag pattern. So that 50% retracement would be around 472.5. So break above 472.5 would invalidate that bear flag and seriously tamper with the short-term bearish case, therefore increasing the odds we do test that range high. What happens beyond that test, if we get it, nobody knows. But in terms of short-term scenarios, they are what I see playing out for not just SPY, but the Qs and IWM, because all three charts look very similar. Qs here looking a bit more vulnerable, however, having already lost and residing below both short-term averages. Can see it's kind of carving out a range here the past 2 days, while still being considerably below its minor downtrend line. So that's the difference right here. You can see we're a lot further below the minor downtrend line in the case of the Qs versus the S&P 500. So what does that tell you? It tells you that tech is underperforming the S&P 500. So a break of this downtrend line would be the first step in the right direction, and it would be a sign that buyers are actually starting to have an appetite again, starting to show some interest. So there's much more work to be done on this chart versus the S&P 500. Note the two red boxes. These represent unfilled gaps. These are a sign of weakness, and they tend to act as a brick wall if price comes back up to fill them. So for me, this chart starts to look a lot better once we take out this minor downtrend line and fill this first gap around the 403 level. This would also be recapturing the short-term moving averages, which is an obvious positive. It's not really, though, until we break above that 404.5 level that we invalidate any potential bear flag that is taking shape. So should that be the case, the probability we test former highs substantially increases. So is this just the beginning of a base forming, or are the Qs forming a bear flag and looking to come down to test that rising 50 moving average? Nobody knows, but the next couple of weeks are sure to be interesting. Now, a couple of charts that lead me to be more optimistic that tech is going to have a legitimate bounce here in the next couple of days are Apple, which is deeply oversold short term, 6 days down in a row or 5 days down in a row, overextended to the downside while running into a major support level, that being the 200 moving average. And this is the perfect recipe for a strong bounce. And considering this is the heaviest weighted stock in the Qs, even if it's to just retrace up lethargically to the short-term moving averages, it could be enough to help push the index higher on its own. So I wouldn't say on its own, but definitely enough to alleviate pressure off the index and therefore allowed to move higher. Same here with Microsoft. You can see it's now 5 days straight into the rising 50 moving average. What is a steep moving average more likely to do over one that is flat? Act as support. It's a more potent support level. Trajectory matters, right? And what just happens to be the second heaviest weighted stock in the Qs? Microsoft. So if this couple gets its act together and they both bounce, it could really help push the indexes higher, alleviate that pressure off the Qs, and that would be obviously very supportive in a potential bounce attempt. Now, if Microsoft rolls here, losing the 50 moving average, it would paint a different picture, but considering how steep this 50 moving average is, I'm really optimistic. And just to be clear now, Microsoft could drop below this 50 moving average a bit even while it's rising, but when it comes to trajectory, the steeper that trajectory, the more likely, even if price does break below it, the bulls do step in. So if price breaks below the 50 moving average, it's not until it starts to flatten out that the odds of a bounce or of it holding as support are going to drastically reduce. However, a lot of times you'll see price break below a steeply rising moving average. And even if it's below for 3-4 days, so long as it stays rising steeply, they're more than likely you're going to see the bulls eventually step back in. So that's something to take into account. A lot of people will prematurely jump into a stock short just because it lost the 50 moving average. Well, that's obviously a negative, but if it's losing a moving average that's steeply rising versus losing a moving average that is flat, it's a whole different ball game. From a probability standpoint, the odds of a rolling after losing a flat 50 moving average versus losing a moving average that's rising steeply is considerably different. Hopefully that makes sense. Finally, IWM, your small caps now down 6 days straight while sitting at this gap support. So this is similar to Apple where it's overextended to the downside. Anything more than 5 days in the same direction constitutes short-term overextension. So considering IWM is sitting at an important support level while price is overextended, there's a good chance we get a bounce here. Now the power behind that bounce, no one knows, but there should be a bounce of some sort nonetheless in the coming days. I wouldn't be surprised if it's as early as Monday. Couple things to note here. Price is below the moving averages. It's below the downtrend line, obviously, and there's an unfilled gap above. So just like the other indexes, there's some work to do here. The Qs, S&P 500, IWM are all kind of in this range over the past 2 days, and a break above it would be the first step in the right direction. Then we have the downtrend line to take out, followed by the unfilled gap resistance, which, by the way, usually it's the top of a gap that would be perceived as the resistance level. So if you want a specific level, you use the top of the gap. If there's a gap that's acting as support, you use the bottom of that gap as that specific support level. So although there's a whole gap here, the majority of traders are assigning the resistance level to the top of that gap range, which in this case would be 199.60. And it's a break above that level that would invalidate any potential bear flag and favor a retest of the former highs. That's where I stand with the indexes. Provided some key levels along with both short-term bullish and bearish scenarios. Will the indexes end up bouncing higher, or are they in the midst of forming a bear flag? Do keep in mind the current trend is up, which means that the favored direction is up. And as of right now, so long as the indexes hold the 50 moving averages, we're in good shape. Dow Jones Industrial Average, kind of technically one of the better of the indexes, not giving back much at all, but it's only 30 stocks, right? And a decent amount of this recent outperformance came from those healthcare stocks holding up really well. Still, obviously, this is above the 20-day moving average. Now let's look at some interesting charts here. So these are the charts that generally move inverse of equities. And this is where the flip side of the argument can come in here. If you look at the 10-year yield, I think we can make a case that this potentially is getting ready to move higher, right? If this was a stock, I'd probably be looking at it and thinking, this looks relatively bullish should it break above the 200 moving average. Granted, you do have a falling 50 moving average just overhead, so that's going to act as another major resistance. But even if yields were to just push up to that 50 moving average, it would likely bring upon enough pressure on the indexes, the equities, to exacerbate this current move down. So it's something to keep an eye on short term for sure. At the same time, we should factor in that this was a pretty powerful move down, and there was very little breather that was taken, much like with the equities raging higher during November and December. There was very little break that was taken. So is it fair to say that perhaps equities are taking a break just like yields are taking a break before they both resume their moves? I think so. So in the case of yields here, we could very much just chop sideways before breaking lower and continuing this downtrend. Same thing with equities. We could just be moving sideways for 3 to 4 weeks, which I think is the favorable outcome, before breaking higher. Same with the dollar chart. However, it's clearly weaker, still residing a considerable amount below both the 50 and the 200 moving average. So a lot more work for this chart to do before it becomes anywhere near bullish. But nonetheless, there are two charts to keep a very close eye on in the coming weeks. If they recapture those long-term moving averages, that 50 and 200, it will be a major hazard for the indexes. Also note these minor uptrend support lines. Remember how the indexes have those minor downtrend lines? Kind of makes that inverse relationship between the two more easy to visualize. So should the indexes break above their downtrend lines, you would want to see assets that move inverse of them breaking below their uptrend lines, right? So it kind of serves as a confirmation tool. That's what you're going to usually see. So those are charts that will not leave us alone, especially as we head into these inflation numbers, CPI and PPI. I don't think it's coincidental that they're setting up in the way that they are, kind of pausing at major resistance levels as we head into these big reports. The market's clearly very indecisive, waiting to see what's going to happen. Now, markets are never going to give you a break and say you're all in the clear. There's no risk involved here, right? And as soon as you start thinking that it is, that's when you're going to get absolutely hammered. So we went sailing higher during November and December. May during that period may have thought, we're in the green right now, right? It's all clear from here. And it's at that very moment of complacency when you let your guard down that the market's going to smack you down, and it really brings you right back down to reality. It's quite literally a humbling mechanism. That's just trading. It's a tough business. You have to be resilient. You have to be aware of the fact that anything can happen, and you have to be willing to adjust. Here we have VIX moving lower on the day, which is interesting because it really felt relatively volatile to me, the trading day on Friday. But when the VIX is moving lower, it's showing that there's a lack of hedging. There's not a lot of emotion in the market at that point in time. Bitcoin kind of all over the place. I know the interest in the SEC decisions about the ETFs is really weighing on everything in this space, but for the most part, just chopping sideways. Some of the names I'm looking at. Now, out of this list of 8, there are only 3 that are what I would perceive as being actionable in my eyes, whereas the rest look like they could potentially be actionable in a couple of days. They just need a little more time to set up. Overall, though, there's not really anything on this list that I'm head over heels with to get involved. I would consider all trades higher risk at this point, especially with the earnings season kicking off next week, the big reports we have. Gap risk is going to increase substantially over the course of the next 3 to 4 weeks. It always does during earning weeks. There's a huge amount of data being dumped onto the markets, right? So there's going to be all kinds of tension brought into the market. Want to be really careful here. And because of that, I'm going to continue to play it slow. But with that said, the first name on the list, which is actionable, I put a little cherry at the top right of all the actionable names, by the way, because who doesn't like cherries, is Ralph Lauren, RL. You can see it's forming a nice little wedge here, holding up better than the indexes. Still above the short-term moving averages, whereas the indexes are below. So a little bit of relative strength there. Could look to go long over Friday's high with a stop below Friday's low. ICE, a financial name, forming this little doji off the 10 EMA. That's a transition candlestick. Could use the high of Friday as your entry point with the low of that candlestick as your stop loss. TRIP is an example of a stock that isn't quite actionable yet, but recent price action has been constructive. It's already recovered the short-term moving averages ahead of the indexes. Some strength there versus the broader market, obviously. We'll look for it to push up against the current range high, and then if going to get involved, I would want to get some kind of pullback to play off of. VKTX, same exact setup here. Looking for the same scenario to play alt. Dash looks pretty good here. Can see that it's pulled back to its breakout location. It's kind of just sitting just above the rising 50 moving average. Once again, note the trajectory. If it pushes up from here, then provides some type of pullback entry, I would be interested, but does need some time. Snow, pretty good looking chart here. I like this one a lot. Retesting its weekly breakout level. So I really like how it closed in the upper range of its daily candlestick on Friday. Look at Shop here. You can see there's a little more wick, right? Now look at Snow. There's very little wick compared to Shop. And that's the way Shop looked, is how many stocks that, although did outperform the market, had considerable amount of wick. That's what it looked like for the majority. Whereas Snow, you can see there's a lot more strength. It was able to withstand the selling pressure and close at the upper end of its range. So it's outshined the majority of even the strongest names. But with that said, does need some time to set up. But looking for something like this to play out. Note, though, this unfilled gap here. Once that's tackled, the chart's going to look really good. ELF had this gap on January 2nd, which led to a powerful move lower that was eventually met with buyers. So gave us this really high volume hammer stick. Bears then tried to follow through the next day, but were unable to. So that's always a good sign. That's bullish. Now it looks like it's kind of showing some relative strength here. You got to keep in mind that IWM has been selling off the last couple of days, and despite that, ELF's held up pretty good. So if ELF were truly to be weak, there was serious technical weakness, it would take advantage of the weakness that we're seeing in the broader market right now and would have completely gotten clobbered. But it didn't. So that's a character change. And in my case, this is constructive price action. So looking for a push higher, either we break above this downtrend line and then I play a pullback or retest that downtrend line, something along those lines. It's going to build out in the next couple of days, so I'll be watching that one closely. So that's the names that I'm watching in the coming days. I'm going to really just take it slow for now. There's not enough direction to get aggressive. That's where I stand with the market as of right now. Have a fantastic weekend, and I will see you guys on Monday. Take care.